On February 22nd, a video was posted on these 5 dividend growth stocks, high-profile dividend growth stocks. And since that time, each of these stocks has fallen in value, some a lot, some a little bit. The question is, was this a mistake? And if it was, what could we learn from it? Or was this not a mistake at all, and what can we learn from the price action that's occurred? Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. You know, one thing that this particular YouTube channel is, and what the Fast Graph fundamentals analyzer software tool is all about, and frankly, what I'm all about is helping people be better, smarter, long-term investors. And I emphasize the words long-term, and I emphasize the word investors. There is a fundamental difference between speculating, which tends to be short-term oriented, and investing, which tends to be longer-term oriented. So what we're going to do is we're going to look back on the video I did last February, about 9 months ago, 8 or 9 months ago, and I covered some growth stocks that were actually subscriber requests from viewers of this channel, and I covered the 5 companies that I thought had a margin of safety. And by the way, in that video, I talked about all 5 of them having a margin of safety. And I did talk about one. I singled out TROW price and said it was the most problematic. And if you go back to that video on 9/10, into that video, you'll see where I talked about TROW price being problematic. And it turned out to be prophetic. But even with TROW price, is that the end of the world as we know it from an investor point of view? So we're going to take a look and revisit that video. And we're going to revisit the 5 companies in that video. And I've prepared a little slide presentation that can help me explain some of the major principles that I'm talking about. So let's go ahead and look at the slide presentation I prepared. And what I've done here is I've contrasted the fast graphs that I presented in February of this year with the fast graphs as they currently sit right now. And you know, one of the things that I'm always talking about on this channel is the importance of doing comprehensive and continuous research and due diligence on your own. The fast graphs tool is a marvelous tool to give you a perspective of the history of the business, how the business has performed as an operating company, how the market has generally priced the business, and then, of course, how the stock price reacts in relation to its fundamentals. And then, of course, I often talk about how the fundamentals change. Now, one of the criticisms I often get on fast graphs, and I find it absolutely ludicrous, is that it relies too much on analyst estimates. Well, first of all, it doesn't rely on analyst estimates. Okay, we provide analyst estimates on the principle that if you're going to invest, you have to forecast. You cannot avoid it. You cannot not do it. And so the logic is, how does the average investor do that? We've got over 20,000 stocks in the Fast Graph research universe right now. And by hopefully early next year, we're going to be adding international and have over 70,000 stocks. How can the average investor possibly forecast all of those companies? Well, you can do it by starting out by going to the lead analysts that follow the stocks. And then, as we'll show later on in this video, you know, you can look at the analyst scorecard and see how accurate those analysts have been and how easy the company that you're reviewing has been to forecast, and then, you know, make some judgments on that. But we never tell you to stop there. We also tell you we provide external links on all of these companies that you can go to, other research sources like Morningstar and Zacks, the Wall Street Journal, Google Finance, Yahoo Finance, Seeking Alpha, other companies, and then, of course, the company's website itself where you can learn more about these companies. There is no substitute for comprehensive research and due diligence. So that's number 1. Number 2, I want to talk about the time frame. This video was produced in February. This was the close of price on the 18th, and the video was done like on the 22nd. I imagine that was a Friday. And this is what 3M looked like. Now, 3M has had some issues. They've got some issues with lawsuits that are pending on various subjects, you know, of the company, but that's normal. Companies like this have it all the time. Now, the question is, what happened to these companies fundamentally? Because in the short run, the stock price is going to be all over the place. And I want you to notice the market has historically valued this at a very high valuation. That's the blue line here on this graph. And yet, you know, typically it should be worth what the orange line is, which is what I videoed about. But I talked about the fact that, you know, it was undervalued based on the way the market normally likes to price it. And at that time, we were getting earnings estimates. So here's this estimate thing. And we were talking about December of 2022 having $10.42 or 3% growth. Well, the current updated version of that is now where analysts are expecting $10.20. So, we've dropped that about 22 cents. It's about a 1% growth rate instead of 3%. But it's not materially different, by the way. And the point is, it still means that the company is worth more than the market is currently valuing it at. And 2023, the estimates are currently at $10.56 for a 4% growth rate. They were $11.10 for a 6% growth rate in February. So they've come down slightly. But I want you to notice that the stock has fallen dramatically. Now, why are stocks down since February? Well, the Fed's been raising interest rates. We all know that. Inflation is running rampant. We are going into what many people believe we are already into a recession, and we've had a bull market turn into a bear market over this time frame. And so we're starting to see the first bear market we've had since the Great Recession back in '08. So there are a lot of reasons why stock prices are volatile. But I want to make this point, and I want to make this point very, very strongly. I want everyone to listen to this. If you believe you can find any guru or person, including yours truly, that can tell you where the price of a stock is going to go in the short run, you're deluding yourselves. That's virtually impossible. You can just look at this price graph and see how erratic and how volatile it is to recognize that you can't really focus on stock price with any degree of certainty or expect to have any degree of precision. Stock prices are very erratic. In the short run, emotions determine market price. In the long run, fundamentals determine market price. Things like earnings determine market price. And so you're much stronger to focus on the earnings and then how the market values that. Now, what's happened here is 3M's valuation has technically dropped a little bit, but the current stock price has fallen more. The stock price was trading about right here when this slide was produced. That was in February. And now the stock price has dropped, but we're already seeing a strong recovery. And I believe we can check it later that the stock is already up today. But I believe it's worth this, orange line as a minimum and possibly this blue line. It's always returned to that. And if you look back at history, anytime we got a chance to buy a company of 3M stature at these very low valuations, when it got below the blue line, that was always a great time to buy the stock. When it got below the orange line, which is the intrinsic value line, this is the market value line, the blue line, then, those have been great long-term buying opportunities. But long-term is key. It takes 3 to 5 years, as I'll discuss here in a little bit more, for a company to grow earnings enough to increase the value of the business. Because the whole idea of value investing is to grow the value of the business. And another thing I want to point out, the dividends haven't really changed here. The estimates have changed, but the dividends have not dropped on 3M. They've actually gone up, and they just declared a regular normal dividend. So that's 3M. Very slight change in the estimates, but we have had a change in stock price, and the stock price is already beginning to recover. This is Altria. Very, very minimal changes in what the earnings were expected to be. And the earnings were expected in February to be $4.85 for 2022. Now they're expected to be $4.84. That's a penny difference. That's no change in really the valuation. The 2023 estimate was for $5.03. It was for $5.14 for 6% growth. Now it's considered to be 4% growth. Really incidental change. Valuation is never precise if you're estimating, especially based on estimates. It's always a range. And even on historical, and then of course 2024, they expected 548 back in 2024, a 7% growth rate. Now we're expecting 4%. The stock has dropped in value, as you can see, but the real valuation, the company still has a very strong margin of safety. As we'll see here in a minute, the dividend yield has gone up dramatically, and the company is still worth far more in this, YouTuber creator's opinion than what the market is valuing it at. And if we look historically, the market has undervalued this stock before, and it's always returned to fair value, and then even got significantly overvalued back in 2015, 16, and 17. So that's Altria, or what I like to call the original Philip Morris. Symbol MO is still the old Philip Morris. Omnicom, one of the largest advertising agencies in the world, we can see that the stock was recovering. Earnings growth was expected to be, it was $6.73 for 2022. They've now actually increased that to $6.76, but the 2023 number has gone down to $6.56 from $7.20, and then 24, which was $7.80, is now $7.07. So we see this little dip, but this company has had dips before and then recovered very strongly, not notwithstanding what happened in COVID, where the stock got very inexpensive. The real value investor sees these things as value opportunities, as opportunities to be a long-term investor in a great business, not a short-term. 8 months is not long enough to judge a company. The company's earnings, even if they've dropped a little bit, haven't changed materially enough to change the valuation of the company. Then going on, TROW price. Now in the video, if you go to section 920, if you want to go back and visit the video I did in February, you'll see that this was one I was concerned with. My concerns turned out to be prophetic, which was obviously not because I'm a genius, because it simply turned out that way. This company is an asset manager, and in a bear market, they've had liquidations, assets, values have gone down on top of that. And so their assets under management are smaller, which means their fees are lower. And you can see the earnings have had a rather significant drop here, much more than it was expected to have a 6% drop in earnings for 2022. Now we're expected to have a 28%, followed by a 12%, which was expected to be a profit. But now we're expecting a strong recovery. And by the way, the last time we had a bear market and a recession, we could see we had a very similar thing go on in TROW price, and then they recovered very strongly. This is a very powerful asset manager and a long-term company. I think this one probably was a mistake in that time because the earnings estimates turned out to be significantly worse than I anticipated, but I did put a cautionary tale out in that video. Investing is never about being perfect. And, in this case, 4 out of 5 ain't bad, I guess you could say. And then finally, last but not least, we got UGI Corporation, a gas utility. And by the way, this company has a September fiscal year end. So for 2022, the estimate back in February was $2.94. It came in at $2.93, about 11 cents short. But then for 2023, the analysts expected $3.38. They now expect $3.23. And then for 2024, we now expect $3.43. They were expecting $3.56. And of course, now we have an upgrade. Again, a very minimal change, hardly noticeable by looking at the two graphs. The company's stock price did drop, a little bit from where it was reported back when this was done. But I do want you to notice it's already, this is where it was. It recovered. It fell again now in this bear market. It's already recovering strongly. So there are the 5 companies that we're talking about. Now, I want to go live here and just talk about these companies a little bit more in the perspective of where they are now. But again, I want to reiterate some things. 8 months is not a long enough time frame to judge a company. Companies only report earnings quarterly, and estimates are simply that. They're forecasts. Hopefully they're better than guesses, but they are estimates. That's why we provide the analyst scorecard and why we provide the opportunity. So let's go look at these companies today. We're looking at 3M. It's recovering nicely. Here are these external links. You can go to these external links and learn more information about the company. You can see 3M is up 1.22% today. You can see some information like October. They talk about job cuts, so you can start doing research by going into these external links. You can also check the analyst scorecard to see how accurate analysts have generally been when they've been making forecasts in the past. That's important. The record for 3M is pretty good. There are some lawsuits that are an overhang right now, but this company does have a margin of safety, and we're already starting to see a spike up in recovery. So was this a mistake? I don't think so. The yield is still there. The company is, continuing to pay the dividend. They've already announced that. If you look at their last earnings call, you can, look at it, and it, it says 3M says stronger dollar dampened sales, but earnings beat estimates. Okay, and they beat estimates by 10 cents, and revenue missed by 100 million, which is really not that's 8.6 billion missed by 100 million. Not what I would call material, enough to hurt the stock initially, but the stock is already recovering. And remember, the market has normally traded this stock at around a 20 multiple. It's currently trading at a 12 multiple, so we'll say it's almost, it's close to 45% undervalued. It has an earnings yield over 8% and a dividend yield of 4.78%, which so far does not appear to be any jeopardy. I think this company is still very, very attractive for the long-term investor who's looking for above-average dividend income and income growth. Altria, as I pointed out, changed very minimally. The stock is down a little bit, but it's still, it's always gone back to this fair value number. I don't see any reason why it's not going to in the future. You can currently buy this with an earnings yield over 10%, a blended PE ratio of 9.5, basically, a dividend yield of over 8%, and a dividend that is not growing real fast right now, but it is growing every year. And that certainly gives you a nice margin of safety. But again, I want you to notice the volatility. The volatility is unpredictable. I don't know how to predict it. You don't know how to predict it. But the key is, even if you bought, let's say here, when the stock was down, just trying to pick a period in time, and the stock fell after, like it has now, after you bought it. If you held it 3 or 4 or 5 years, look what happened to your rates of return. And you can see that pattern, happen over and over again. You could buy the stock when it was relatively inexpensive. You could have watched it drop in value, but you hold it 3 to 5 years and you make money again. In the meantime, you collect your dividends. If you're a long-term investor, you don't buy stocks to sell them immediately. You buy them to hold them and to collect the income and trust that eventually the fundamentals will manifest and the stocks will rise to their intrinsic value. Going into Omnicom Group, a little bit of stress going on in the company right now with a recession. You can understand that. But the company is still expected to be worth more than the market is currently valuing at. Historically, the market likes to even put a premium valuation on this stock. So, you could look at these high levels, even with current estimates showing some weakness right now. The stock still looks, very, very attractive. You could go into, again, a company like Seeking Alpha here, and, analysts like the organic growth after the solid third quarter beat. So they actually had a better forecast than the analysts expected in this last go around. So that's a positive in my view. You can see the stock is already recovering off of lows, but I think it has a lot further to go. Currently has an earnings yield over 9%. You can buy it at 10.79 times earnings, and the dividend yield is approaching 4%. And so I think Omnicom is still an extremely attractive buy, and I still think it has a strong margin of safety today. TROW price is the one that I, referenced in the video. If you go to the old video I did, first of all, it was the most recent comment. I just got that comment yesterday, okay? And I thought it was really interesting from Benjamin Jordan. And he said 8 months later, 3M is down 15%, Altria is down 12%, Omnicom 14%, TROW price is down 30%, UGI down 9%. I appreciate your videos and the value of your smart software. Thank you, Benjamin. I also appreciate that it's not making these videos not easy, but if you've done poorly, maybe unappealing as it would be for a new investor like me to go back and revisit these. I'm going to paraphrase this now. What can I learn from my mistake? And would it also be a good practice for an experienced investor and YouTube creator to exemplify these habits? Revisiting the ideas should be a valuable conversation considering the drawdowns. Well, number one, these drawdowns I consider irrelevant. When they asked the immortal Ben Graham, once when he was dogged by a reporter, to share all his wisdom about the stock market, and he kept avoiding answering the question, or avoiding the thing. He finally, with the persistence of this journalist, he finally said, okay, just what do you want? And the journalist said, I want you to share all your infinite wisdom about the stock market. And Ben Graham said, you could have saved us both a lot of time. I can tell you everything I know about the stock market in 2 words. It fluctuates. And that's the point. Stock prices will always fluctuate, and nobody can predict the short term. And 8 months or 9 months is still the short term. If you're going to be a long-term investor and a value investor, you got to understand you're often buying stocks that are out of favor, which means they have weakness. You also have to realize that it takes time for the companies to build value, and that usually takes a business cycle, which is a minimum of 3 to 5 years. And I stress the word minimum. And I responded to Benjamin. I said, there are several important principles. 8 months is not an adequate time frame, which I've just reiterated. To my thinking, you got to go a business cycle, 3 to 5 years, the minimum time frame. Also, I went on to say fundamentals matter more than price in the long run. And regarding these examples, only TROW price has shown fundamental stress and has been, minimal, whatever I meant by that. The other companies are still showing strength in all the important fundamentals. And in the video, just to be on record, I did at around 9:10 on the video point out that I did consider TROW price the most problematic of these groups. Remember, these were viewer requests. So here's what I said about TROW price. For above average yields, and they all offer above average dividend growth. So, you might want to take a closer look at all of them. The one that, I found most problematic or confusing is T. Rowe Price, but yet T. Rowe Price is really a premier, money management firm. So I don't think you can go wrong buying it at these levels. Anyway, this has been Chuck Carnevale saying thanks for watching this video, this update. I did find it interesting and I did find it important. There are some really important lessons in here. It's never enough to know that a stock price has gone up or stock price has gone down. It's much more important to know why. And also, as Warren Buffett once said, everybody knows the price of everything and the value of nothing. It's so important to understand the value of the stocks you own so that you don't let the bouncing price ball get, into your crawl. And that's one of the real beauties of fast graphs. It's the only tool I know of that really illustrates the fundamental value of the business and contrasts it to how the market is pricing that business, whether it's overvalued, undervalued, or fairly valued. And that is just such important information to have, because if you can focus on fundamentals first, you can sleep well at night with your investments. You can look at your portfolio, and if the price is down a little bit and you weren't intending to sell the stock in the first place, you can make intelligent decisions like continuing to hold or even adding more if you have the wherewithal to do that. So I hope you enjoyed this video. I don't think those companies were a mistake in February. I even don't think T. Rowe Price is a long-term mistake, although I do think it is one that had stress. I think in the long run, if you're investing for income and stability and long-term, opportunity, I think all of these names actually still fit the bill. They're all very good companies. But again, investing is never a game of perfect. Don't just know that your stocks are up or down. Know why they're up or down, but most importantly, know the value of the things you hold. Because one of my cardinal rules is I'm never willing to sell anything for less than I believe it's worth. Thanks for watching. If you liked it, give me a like, ring the bell, subscribe to the channel. And if you haven't already, if you own stocks, for goodness sake, take a look at fast graphs. They can really help you make better long-term investment decisions. Thanks for watching.